Brent crude oil occupies a peculiar and powerful position in the modern global economy. It is spoken of daily on financial news channels, referenced in government budgets, monitored by central banks, and watched obsessively by traders. Yet its physical presence is surprisingly modest. Brent is not the most abundant oil, nor the cheapest, nor the easiest to extract. What makes it extraordinary is that it has become one of the world's most important reference prices, shaping the cost of energy for entire continents. To understand Brent crude is therefore to understand not merely oil, but the invisible architecture of global commodity trade itself. The term Brent crude originally referred to oil produced from a single field in the North Sea, discovered in the early 1970s. Over time, however, Brent evolved from a geological reality into a financial construct. Today, it represents a pricing benchmark derived from several North American North Sea crude streams, collectively used to establish a reference price rather than to describe a specific physical blend. This evolution reflects a broader truth about commodity markets. Once a benchmark gains credibility, liquidity, and institutional acceptance, its physical origins become secondary to its financial role. Brent crude is classified as a light sweet oil, meaning it has relatively low density and low sulfur content. These properties make it easier to refine into high value products such as gasoline, diesel, and jet fuel. Historically, this quality advantage helped Brent gain acceptance among refiners, but quality alone does not explain its global dominance. Many oils share similar characteristics. Brent's real strength lies in where it is produced, how it is traded, and how it became embedded in global market systems. The North Sea, where Brent originates, is politically stable, legally transparent, and geographically well positioned for maritime trade. Unlike landlocked oil benchmarks, North Sea oil is produced offshore and transported by tanker, making it inherently flexible. Cargoes can be redirected mid-journey in response to price signals, geopolitical disruptions, or changes in demand. This seaborne nature aligns perfectly with the realities of international oil trade, where flexibility and arbitrage are essential. As oil markets globalized in the late 20th century, Brent emerged as a natural anchor for international pricing. Over time, Brent ceased to be merely a price for North Sea oil and instead became the reference against which much of the world's oil is priced. Today, a majority of internationally traded crude oil cargoes are sold using formulas linked to Brent. Producers in Africa, the Middle East, and parts of Europe often price their exports as Brent plus or minus a differential that reflects quality, location, and market conditions. In effect, Brent acts as a universal language through which buyers and sellers communicate value. What is striking about Brent's dominance is that it persists even as North Sea production declines. The fields that once supplied large volumes of oil are maturing, and output has fallen significantly from its peak. Yet Brent's importance has not diminished. This apparent contradiction highlights a crucial insight. In modern commodity markets, price discovery matters more than production volume. Brent remains dominant because it is trusted, deeply liquid, and embedded in financial infrastructure. Contracts, risk models, hedging strategies, and government fiscal plans are all built around it. Replacing such a benchmark is far more difficult than producing oil. The comparison between Brent and West Texas Intermediate, the primary American oil benchmark, further illustrates why Brent occupies a global role. WTI is priced at Cushing, Oklahoma, a landlocked hub connected by pipelines rather than open seas. When WTI reflects conditions in North American markets, it does not capture the full complexity of global oil trade. Brent, by contrast, reflects shipping costs, maritime risks, and international supply dynamics. Since oil is ultimately a globally traded commodity transported mostly by sea, Brent's pricing structure aligns more closely with real-world trade flows. Brent's influence is magnified through financial markets. The most important venue for Brent trading, is the futures market, particularly the Brent crude futures contract traded on the Intercontinental Exchange. These futures contracts allow market participants to buy and sell oil for future delivery, or more accurately, to settle financially against a benchmark price. The volume traded in these markets dwarfs physical oil trade by orders of magnitude. On many days, the number of paper barrels exchanged exceeds physical production by thousands of times. This financialization transforms Brent into a macroeconomic instrument rather than a simple commodity. Through derivatives, Brent becomes woven into countless economic decisions. Airlines hedge fuel costs against Brent. Governments forecast tax revenues based on Brent price assumptions. Investors use Brent as a hedge against inflation or geopolitical risk. Even consumers feel its influence indirectly, as changes in Brent prices feed into transportation costs, food prices, and electricity bills. In this sense, Brent functions as a transmission mechanism through which energy costs ripple across the global economy. Geopolitics plays a central role in shaping Brent prices. Because Brent reflects international trade rather than domestic supply conditions, it reacts quickly to geopolitical tensions. Conflicts in the Middle East, sanctions on major producers, disruptions in shipping lanes, or even rhetorical escalations between states can move Brent prices sharply. Importantly, these movements often occur before any physical disruption to supply. Markets price risk and expectation as much as reality, and Brent serves as a real-time indicator of global uncertainty. The relationship between Brent and major oil-producing states adds another layer of complexity. While Brent pricing occurs in open, market-driven environments, supply decisions are often shaped by coordinated actions from producer groups such as OPEC and its allies. These producers do not directly set Brent prices, but their decisions influence supply expectations, which in turn affect market sentiment. Most oil exported by these countries is priced relative to Brent, creating a feedback loop between market benchmarks and state strategy. Brent thus sits at the intersection of free markets and geopolitical power. Brent's impact on national economies is profound. For oil importing countries, rising Brent prices can worsen trade balances, weaken currencies, and fuel inflation. For exporting countries, higher prices can stabilize budgets, fund social programs, or strengthen geopolitical leverage. Central banks monitor Brent closely because energy prices influence inflation expectations and interest rate decisions. Few other commodities exert such a direct influence on both monetary and fiscal policy across so many countries. As the world confronts climate change and transitions toward cleaner energy systems, Brent's future role is increasingly debated. Some argue that oil benchmarks will lose relevance as demand declines and renewable energy expands. Yet even under aggressive decarbonization scenarios, oil remains deeply embedded in transportation, aviation, shipping, petrochemicals, and industrial processes. Demand may plateau or decline gradually, but it is unlikely to vanish abruptly. In this environment, Brent may become more volatile rather than less important, reflecting tighter supply, underinvestment, and geopolitical uncertainty. Paradoxically, efforts to reduce oil dependence can contribute to price instability. As investors shy away from fossil fuel projects and capital expenditure declines, supply growth may lag demand, leading to sharper price movements. Brent, as the primary global benchmark, becomes the focal point of this volatility. Rather than fading quietly, it may become an even more sensitive indicator of transition risk. There is also ongoing discussion about whether alternative benchmarks could challenge Brent's dominance. New benchmarks tied to Middle Eastern or Asian markets are gaining traction, and US exports priced against American benchmarks are increasingly influential. However, benchmarks derive power not only from production but from institutional inertia. Contracts, regulations, accounting systems, and financial products have been built around Brent for decades. Replacing it would require coordinated change across governments, corporations, and financial institutions, a process that tends to unfold slowly.